Welcome back to Smart Stock Sam. What if I tell you that a biotech company grew revenue by 750% in 1 year while drowning in a $3.7 billion debt crisis? Sounds impossible, right? Today we're diving deep into ImmunityBio ticker IBRX to answer the ultimate question: is this the biotech breakout of the decade, or a catastrophic value trap waiting to implode? By the end of this analysis, you'll know exactly whether IBRX deserves a spot in your portfolio or if you should run for the hills. Let's get into it. ImmunityBio is living in what I call strategic tension. Imagine a scale. On one side, their revolutionary CancerBioShield platform, a vision of a chemo-free future that could rewrite oncology. On the other, there's a going concern warning, a $3.7 billion accumulated deficit, and a ticking clock on debt covenants expiring in 2029. This isn't just a company with problems. This is a full-blown race against time where liquidity could determine whether investors see life-changing returns or total devastation. So the question isn't, can they innovate? It's, can they survive long enough to cash in on that innovation? Let's talk about what makes the bulls so excited: the CancerBioShield platform. This isn't about one miracle drug. It's an entire ecosystem designed to coordinate attacks on multiple cancer types. We're talking bladder cancer, lung cancer, lymphoma, even glioblastoma, one of the deadliest brain cancers known to medicine. But here's the game changer. The mechanism isn't just about killing cancer cells. It's about establishing immunological memory. Think of it like training your immune system to remember the enemy. So even after treatment ends, your body stays on guard, hunting down any rogue cells. If this works at scale, we're talking about fundamentally changing how we think about cancer survival. Now here's where ImmunityBio separates itself from the pack. Traditional CAR-T therapies, the current gold standard, are an absolute logistical nightmare. They're patient-specific, meaning every treatment has to be custom-made from the patient's own cells. They're insanely expensive, often running into the hundreds of thousands of dollars. And worst of all, they require toxic chemotherapy just to prepare the patient's body. It's a brutal process. Enter ImmunityBio CAR-NK therapy. This is off the shelf, meaning it's pre-made and ready to go. It's chemo-free, sparing patients from that horrific prep phase. And it's scalable, which means it can be manufactured in bulk and administered in outpatient settings. If this platform proves itself, the current multi-billion-dollar CAR-T market doesn't just face competition, it faces obsolescence. And we're not just relying on hype here. The clinical data is starting to validate the thesis. In bladder cancer trials, we're seeing durable responses. In lung cancer, survival rates are improving in patients where every other therapy failed. We're literally watching innate immune activation replace toxic lymphodepletion in real time. The science is screaming buy. But if you're a rational investor, you know that great science doesn't always translate to great stock performance. And that's because while the clinical data is impressive, the financial picture is absolutely terrifying. Let's talk numbers. Revenue skyrocketed from under $7 million to $113 million in 2025. That's not a typo. 750% growth in a single year. They're executing what I call global regulatory arbitrage, getting approvals in markets like Saudi Arabia and Turkey to generate cash flow that funds their expensive US development pipeline. On the surface, this looks like a company firing on all cylinders. But here's the problem. Despite that explosive revenue growth, they're sitting on a $3.7 billion accumulated deficit. Let me say that again, $3.7 billion in losses. That's revenue growth barely making a dent. They're still burning cash and entirely dependent on founder Patrick Soon-shiong to keep writing checks. And it gets worse. Enter the Oberland Debt Trap. ImmunityBio signed a $300 million debt agreement with Oberland Capital with a hard deadline, December 31st, 2029. If their revenue doesn't hit a specific growth trajectory by then, a true-up payment triggers. That's not just a cash flow problem. That's a potential death sentence for the stock. Imagine being an investor, watching the clock tick down, knowing that if the company doesn't hit its marks, a massive liability could wipe out shareholder value overnight. This isn't theoretical. This is structural risk baked into the balance sheet. Now let's talk about regulatory risk, because this is where things get really messy. Company press releases have been hyping rapid expansion into papillary tumors, a subtype of bladder cancer. Sounds great, right? But here's the disconnect. When you dig into the SEC filings, the FDA might require a multi-year randomized controlled trial comparing their therapy directly to chemotherapy before granting full approval. That's years of delay and hundreds of millions in additional costs. This discrepancy between the headlines and the fine print is the primary driver of the insane volatility we're seeing. Investors who only read press releases think approval is around the corner. Investors who read the filings know it could be a marathon, not a sprint. And if that wasn't enough, the company is fighting a three-front legal war: securities fraud allegations regarding their glioblastoma data, derivative lawsuits from shareholders, and claims of self-dealing involving founder Patrick Soon-Shiong. These aren't just nuisances, they're a valuation ceiling. No matter how good the clinical data looks, institutional investors won't touch this stock with a 10-foot pole until these legal clouds clear. It's creating a disconnect where retail investors are celebrating 90% gains while institutional money sits on the sidelines, terrified of the balance sheet and courtroom drama. So, what does this mean for you? The market is treating ImmunityBio as a battleground stock. Fair value estimates are all over the map, ranging from 33 cents to over $20 per share. Retail traders are riding momentum, institutions are pricing in catastrophic dilution risk, and everyone is waiting for the same thing: clarity. Here's my verdict: wait for the March 2026 catalyst window. This is the definitive moment. If the FDA provides a clear path for papillary tumor approval without requiring a brand new trial, or if the company secures non-dilutive financing to bridge the capital chasm, this stock has explosive upside potential. We're talking the possibility of multi-bagger returns if everything aligns. But if we see a mandate for new trials or another massive dilution event where existing shareholders get crushed, you need to get out immediately. The science is valid, the platform has real potential, but in biotech, liquidity is king. If they can't fund the vision dies. Before I see you off, crucial reminder like always, this video is for educational and informational purposes only and should not be construed as financial advice. I am not a licensed financial advisor, and the content presented here reflects my personal opinions and analysis. Investing in stocks, especially biotech companies, carries significant risk, including the potential loss of your entire investment. Before making any investment decisions, please conduct your own research and consult with a qualified financial professional. Past performance is not indicative of future results. So that's the full picture on ImmunityBio revolutionary science, catastrophic financial risk, and a March 2026 deadline that could make or break everything. If you found this analysis helpful, smash that like button, subscribe to Smart Stock Sam for more deep dives, and drop a comment below with your thoughts on IBRX. Are you bullish on the science or staying away until the financials improve? Let's discuss. Until next time, stay smart, stay informed, and I'll see you in the next one.